The big thing for me is continuing to add these systems, making sure there's systems in place so I can scale and not be taking on a new job every time I buy a property. I'm leveraging a team of people so that it's as passive as you can make it. It's never, for me, it's never going to be purely passive because I'm way too hands-on and a control freak a little bit with that stuff. But when you own I'm that way right now with 13 units. And so I'm like, okay, when I own 2,000 units, I'm like, I got to be a little more hands off.
Hello, everyone, and welcome to another episode of the Adventures of a Real Estate Broker with Daniel Berger. Today, I'm excited to have someone who's a civil engineer. He's a real estate investor. He's a 10X business coach. If that wasn't enough, he's also a Marine Corps veteran. He's helped out with Habitat for Humanity for over 10 years. And we'll get into a little bit more, but just Chris Jensen. Jansen, thank you very much for coming on the show this week.
Yeah, absolutely, Daniel. Thank you so much for having me.
If those things weren't enough, and also I want to thank you for your service. That's how many years were you in the Marine Corps?
Yeah, thanks. I spent 4 years in the Marines.
So we appreciate that because obviously, as they say, freedom's not free, and we need people to actually volunteer and serve in the military to make our country amazing. So I appreciate that. But if that wasn't enough, I believe you also have a BS in engineering from some school in California, UCLA. It's a little school out there. And I believe a master's from Stanford, a master's in science, right?
Yeah, they're both in civil and environmental engineering. So
So
stuck through that path.
that is a an amazing resume. So that is
Thank you.
unbelievable. Unbelievable. What was harder, the Marine Corps or Stanford University?
They were very different types of hard. So that's a tough question to answer. Probably the Marine Corps, though.
I
If I had to
oh
pick one. Yeah, if I
yeah.
had to pick one.
So what's interesting is being an engineer, I would think that it's fairly regimented, right? Like you don't really it's you're basically science based, which to me, science, not being a science guy, is there's obviously rules of nature and you have to follow those
Mm,
rules of nature. And the Marine Corps is there's a set guidelines, right? You don't really go rogue in the
mm.
Marine Corps. It's we have a track record, we follow it, there's everything standard. And now you're a real estate investor where it seems like it's probably the Wild West for some people, but I'm assuming that you've probably taken it and standardized it.
That's a great, yeah, assessment. I don't think anybody's really put it that way, but I will say I love having structure and I thrive having structure in my life. Definitely getting all those things in order in place in the real estate side as well has been very helpful for me. Yeah, I would agree with that. And I've only been doing that, the real estate investing for a few years now, but there were like almost a full year of that where I wasn't super structured and I was more shooting from the hip, looking at properties anywhere I saw a potential deal across the country. And I don't think I did maybe one deal that whole year. I was just too distracted by looking at all these other things because I didn't have those structures in place. So this year I really honed in on the structure and that's been helpful. Definitely.
I'm glad that I found that analogy that of you putting structure in a crazy world. So
Yeah,
when
definitely.
people are listening to the podcast, they're like, that Danny has every now and then comes up with sees something. It's I probably hope that I'm less structured in the way that I like to go do things, but I probably hone in on a few things. So clearly, if you hone in on a few things and try to do those, maybe the less structured is a little different because if you're looking at investments all over the country, you're like where you have no focus.
Yeah, yeah.
And so
Exactly.
what are the things that right now that you're focusing on in as an investor? What are the things that you're doing there to what marketplace and what types of because I think you're also trying to put together it's not just properties that you're buying, it's properties that you're buying as well with other bringing in other passive investors. And so what are the things that you're doing right
Yeah.
now?
So I am in a transition period on my investing journey. And a lot of that's certainly influenced by Grant Cardone and the 10X community as well, because obviously he's all in on multifamily, large A-class multifamily, beautiful buildings. My portfolio is really right now a lot of older duplexes in Wisconsin, mainly in the Midwest. I do have a couple condos here in Santa Ana, California, Orange County, where I live, and just because those were more house hacking kind of deals, and that mix has served me well up to this point because you get a lot of appreciation with the properties you buy in California, not so much in Wisconsin, but then Wisconsin gives me a lot more cash flow, and then just there's ups and downs with each type of property, but I feel like that's a good mix. But I'm really trying to scale, embrace the 10x mentality, and just amplify my gains, my portfolio. And the way that I know to do that is through multifamily. And so that's really what I've been focusing on, I'd say for the second half of this year. And I've put in probably I think four offers at this point. None of them gone through yet. These are bigger deals that I'm working on. So when it does go through, it'll be fun. Then it's gonna be going out there raising capital, bringing in partners that way. I did buy my first multifamily commercial, if you will, property this year. It was a 5 units in Milwaukee, Wisconsin, but I didn't have to raise capital because of the way we structured it. Basically, got creative and they were willing to finance a little over half the deal, a really good rate, and then the other half I got commercial loan on. And I actually hardly had to put any money into that to buy that one. But yeah, again, looking at bigger stuff in the millions, which in California it's okay, millions. What do you do?
I mean, that's like
That's
a
a single
vacant lot.
family.
No, that's a vacant
Right.
lot.
Yeah, exactly, right? There's not even any improvements there. But Wisconsin, okay, that's a little bit like there's a 34 unit property for 1.5 million. I mean, come on. It's
Right.
ridiculous. It's all that one, it's all mostly studios and stuff, and it's the cap rate is terrible on that one, so I don't think I'm even going to pursue it. But that's just an example. That's a lot different.
I do think that it's good that you're putting in offers for numbers that you think make sense for you, and then you don't
Yeah,
chase it, right?
yeah,
You let it sit, especially if you could
yeah,
offer it. It doesn't cost you money to place an offer, so it's certainly.
yeah.
I just have a dog in the room, and
It's okay.
so I like the idea that you're looking at things that make sense to you, and then you're putting in offers that make sense to you. Some of them are going to
Yeah,
work, some of them are not going to work. Many times deals will you won't get it originally, and then as the buyers look at other deals, the deals fall apart. So I was looking forward to speaking to you because of many things, but so I'm like an anti paying for a coach guy, right? So I love that you bring up the Grant Cardone and his principles of the 10x, right? Because
Mhm.
don't get me wrong, I think his business model and Tom Ferry's model, they're great. They have people paying them $1,000 a month to be a coach, and they hire coaches to do coaches, and it's a whole big
Yeah,
business. But what's interesting is, and you're one of education. So I have an MBA, I have an undergrad degree, a BSBA, and an MBA, but not at the schools of UCLA and Stanford. But my brother is a fellow Stanford Mafia person. I think that's right. Isn't that what you guys said? He was in the
hmm
business school, but
Okay,
you
gotcha.
know, but so why I think why coaching and those things are good is because many people want direction, right? And you're someone that likes structure. So you didn't like how would you have the
Yeah,
structure if you haven't
yeah,
done it before? And so while you could go do it and then build your own structure, you seem like a person, and many people are like that you're like, listen, I'm going to tap into something, and clearly I have to pay for that. But you're paying for education, just like you're paying to go to UCLA or Stanford. You're paying to get education, so it's really no
yeah.
different in that standpoint. And Grant Cardone's program is one that works for him and many people, and so you're tapping into that. And I'm assuming that you're tweaking it to make it to put Chris's own views in things where you feel appropriate.
Yeah, absolutely. Before 10X, and I'm still part of this other group too. Before I bought any deals, I joined a separate group. I don't know if you've heard of Renatus before. So it's an educational system. They have 90 classes and almost in so many different strategies within real estate investing and growing a business. So that was my first kind of group that I went into, and I did pay for that. And it was like a mastermind group. That's where I really learned like most of what I know about real estate. And there are some multifamily people in there. There's a couple multifamily classes that helped me get some the fundamentals down of that. And then I actually went to grants more for the coaching on the business side to learn the sales and marketing. And they're like, "Oh, you're into real estate. Here, let me throw in." I thought I was playing hardball. Like it's their sales guys are incredible, which is also why I'm like, I have to learn from you. I have to learn what you guys are doing because clearly it works really well. But they never will lower the price ever. It's like a cardinal sin for them to ever lower the price on anything, but they will add value by throwing in other stuff, right? Hot tip, I guess, if you're ever trying to purchase something from the 10X group. But so they threw in, oh, you're a real estate investor. Let me throw in these classes. Let me throw in real estate summit and stuff like that. So I went to my first real estate summit, and that's when I realized, holy crap, I am I need to be in this room. Like the room I have been in, I started off at the bottom, quickly worked my way up, realized most of the people in that room weren't really actually taking the necessary actions to get into deals, and I quickly escalated to the kind of the top of that group. And I wasn't really growing anymore. And now I come over to this real estate summit. I paid for VIP, which meant that we get a special lunch, but we get to talk and ask questions directly to Grant. And then we're also sitting in the room with other people who have the means to pay for something like that. And just all the people I met who own thousands of units, it was just blew my freaking mind. And like how quickly some of these people scaled. There was a lady and her sister, they bought their first 2,000 units in I think 5 years between the two of them. I'm like, geez, that's awesome because that's exactly where I'm trying to. That's my goal is 2,000 units, my 10x goal, right? Now that I have that in place, and
What is 2000? What's the benefit of 2000 units? What if you get there? What's your profit and what does that look like? How many? It's obviously 2000 units, but you know
yeah.
how much in loans? How much in capital investment? What does that produce in results?
Yeah, so one thing I'll say, I'm not getting into the heavy mechanics of that because the obviously if I own 2,000 units, the money's gonna be there. But initially, because when I buy like a duplex or whatnot, my goal is always $200 minimum per door cash flow after all the expenses and things, and trying to be as realistic as possible with those expenses and not lying to myself about that. But so that's what I use initially. So that's 400,000 a month in cash flow, which is insane. But like in my mind, I'm like, okay, now I'm getting into multifamily, I'm like, all right, if I'm gonna do an 80-20 equity split syndication model, which is very common, right? Okay, now I'm only getting 20% plus then 80% of anything I put into it. And so obviously it's going to dilute the gains quite a bit. But nonetheless, the deals I've been running for me have been like $50 to $100 a door for me. And the more capital we raise, the more that number goes up as well, because then that means you're putting down more and taking out less in the loan. So generally, my minimum is like 25% down, but usually I'm looking more closer to like 30% down, 75% loan to, or 70% loan to value, maybe 65 at the low end. It just depends on the deal. But to me, that number depends heavily on the cash flow because the other side of this is the more cash flow I have per property, the less that's lowering my risk, right? If shit goes wrong, shit hits the fan, I got a ton of cash flow coming in, I can handle that and absorb that. And especially if across 2,000 units. The big thing for me is continuing to add these systems, making sure there's systems in place so I can scale and not be taking on a new job every time I buy a property. I'm leveraging a team of people so that it's as passive as you can make it. For me, it's never going to be purely passive because I'm way too hands-on and a control freak a little bit with that stuff. But when you own, I'm that way right now with 13 units. And so I'm like, okay, when I own 2,000 units, I'm like, I got to be a little more hands off or I'm going to go
Right. But
insane. But
13
like,
units. So you're in
yeah,
two states right now, right? California and Wisconsin, you said.
I also have one in Utah as well. Yeah.
So how do you then keep like even up with what the laws are, right? Because the laws are
Mhm.
different in each state.
Yeah, it's pretty simple with the these are all long-term rentals, so there's nothing too crazy. I self-manage here in California, so I have to be a little more proactive with that. But also my tenants here have been really awesome, which I'm just super grateful for because it could go easily go the opposite way.
But right.
But yeah, so that's one thing. And then but then yeah, the other areas I'm still up to date with those laws and things because it's still ultimately my responsibility, even if, say, a property manager breaks some fair housing laws for the state. But I know the federal rules, obviously, and then just have to stay up to date on the local laws as well.
So for me, it's funny because I'm not trying to get to 2,000 doors. So, because that's obviously insane and that's its own business. But as being a real estate, first as an agent, then as a broker, and then just trying to seize opportunities when they come, you have one door. I actually have a couple of doors, but besides my house,
Yeah.
I do own a townhouse with a contractor, but it's in the town that I
Yeah.
live in. I know the rules.
Yeah.
We're self-managing it for the lease. We do the lease. We do all that, and then my contractor, obviously my partner, can go fix things, anything that's done. It's
Yeah.
amazing to have that many doors because you're going to need to have a lot of help. Because I got lucky when I switched from my last tenant to this tenant, I had no downtime. I had 6 days of downtime, which was what my partner wanted to have so that he could redo like the floors and some other stuff. Those are the things that you never know about. So going from one lease to another. And then I also
Hmm.
just so what I did, what you might find interesting, I see one of my clients and he's managing a fair amount of properties. He probably has like 15 or so, and he flips them in and out. And because and I see why is he flipping so much? It's because the depreciation's worn out on that one, and now he's trying to move it into something else.
Hmm.
And I'm listening to him, and okay, accelerate depreciation, all this other
Hmm.
stuff. And then and I talk to my accountant about it, and he's yeah,
Hmm.
you can do all that. I'm like, why haven't you proactively told me
Yeah.
about that? Right.
Yeah. Because yeah,
So I
they,
actually,
Trump's the big beautiful bill, right? It brought back the accelerated bonus depreciation. So that's huge for real estate
and
investors. And
listen,
yeah.
you can be on any side of the aisle. It's irrelevant. But whatever the
Yeah.
law is in place, you need to, right, to be a smart
Yeah.
investor, you follow what the rules are. And if there's something there that you can take to lower your tax burden, it doesn't matter who put
Mm.
it in, you follow it, right? Because
Yeah.
so that you'll be proud of me. I don't know how many doors this is because we just bought a firehouse in a cute
Oh,
town in New York where we bought a firehouse from the municipality. We already have our tenant. We before we even bought it, we signed a lease with a tenant who's going to
nice.
do like an office, is going to do a coffee bar, wine bar, event space, and then we're going to create 4 apartments. So I guess that's 5 doors. So we're going to
Nice.
have
Nice.
two
Congrats.
beds, 1 bath on the second and third floor. I'm dipping my toe into the water, but what's interesting from us in that standpoint, and this is what you talked about, accelerated depreciation and things that you need to know about, is technically you're not allowed to start doing that until it's a working asset. That's the rule. Luckily for us, this firehouse actually has a cell tower on the roof. And that cell
Mm.
tower generates $25,000 a year of revenue. So you're able to accelerate depreciation from the moment you purchase the property.
Yeah,
So,
nice. Well, that's great.
so
Yeah, what I'll say too about this, like with the laws and especially the tax code, like obviously you need to have the right people on your team too. So like I have attorneys in each of those states that are specifically real estate attorneys as well that I know I can go to if I need a new contract written up or I just have questions about something or I'm running into an issue with something. So that's important to have that. And then for me, I have initially I used like I tried doing my own taxes. Then I had a tax preparer. Now we have a CPA going up and up and now I have a bookkeeper because one, I didn't get into this business to keep books. I didn't get into this business to manage properties. I didn't get into this business to be a lawyer and a CPA. So I want those experts on my team because I know that's their job. Like they're up to date on those things. But I want to know I'm just trying to keep a lookout on a high level, so at least I know what questions to ask them and point them in the right direction and see if, hey, would this work? Would this work? These different strategies. So yeah, I haven't actually used cost seg yet because my property values, these are older, like I said, homes in Wisconsin. So the values of the property themselves, it doesn't really make sense to do the cost seg. And I've consulted with a couple different experts on that. But multifamily, absolutely, commercial, absolutely. Like what Grant does, which I think a lot of people do. It's the name of the game, I think, with the multifamily space is like you buy, especially if you have a business, you own a business on the side that's generating revenue or even a day job. If you qualify, you have to qualify for real estate tax, what are the real estate professional status on your tax return to do this. But basically, you make as much money as you can during the year. And then at the end of the year, you go buy, you dump it into a new asset, right? You accelerate the depreciation, and then you write off all your active income. And so then you basically don't pay any taxes. And then you
It,
just
right.
do that. You just do
It's
that every
tax
year.
correct. So those are the things that I'm watching is because I just sold like a $2.7 million condo for my partner this like the other day, and we have
Nice.
45 days to put it back in because he's going to do a 1031 exchange.
Yeah,
So those are things that like for me being a broker and an agent, I'm slowly finding the right people to do it with and then taking on projects that make sense. Scaling can be good, but scaling for the sake of scaling, not necessarily. For you, it's a little different because you're younger and more handsome than me. And so your goal is to like this is you're trying to generate really a long-term business plan
you-
to be able to use and to set things up for more from a passive way, right? Or you might active,
exactly.
but you'll get paid to actively manage it. I think what's also cool of what you're trying to do is again, you talk about a lot where people like to say that they're going to do stuff and then they never follow through on it. And so for you to be able to go buy assets and then, the plan in place and then sell equity stakes in those ventures, that's how you're going to get
Mhm.
paid too, right? Because there's some
Yeah.
people that are just like, listen, it's above me. I'm never going to do that. But I do have some money, 50,000, a
Yeah.
100,000, whatever, that I'll throw into a deal with you. And then you're going to basically package that
Yeah.
together, and then you're going to have multiple things of that. So
Yeah,
that's
and the more I get into this too, like the more, naturally opportunities pop up and you learn about different strategies and things you can use. And I actually just put a very little bit of money into a limited partnership on a San Antonio deal as well. So I did that. But these guys I met through the real estate club, Grant Cardone's real estate club. And they're under contract for three different 150, 250 unit apartments in San Antonio, all three at the same time. I'm like, dude, you guys are crushing it. But so these are awesome guys. They have like weekly calls and stuff. And they recommended to me like, hey, you should go look into doing a fund of funds. And I'm like, what's a fund of fund? And so I looked into that. And this is like a way where you could actually just basically get a larger equity stake in a deal just for raising capital. It's a unique way of doing it. It's like you set up your fund, you raise money, and then that fund goes and puts money into another fund, but they do it in a way that doesn't dilute the gains. It's really interesting and strategic. And the only reason I'm even thinking about that is because I'm trying to build my sort of a brand and followers and community. And I want to always have deals to offer people. And so if I have my deals is one pot of deals, and then I do a fund of funds, now I can tap into other people's deals that I like and raise, and so that I always have something to share with other people. And then on the other side is the coaching, which is more like, hey, if you want to actively invest, then I can teach you how to do that. Or if you have a business, I can help you on the business side with coaching. And then the more money you make there, let's put all that into real estate. I've got this fund of funds, or I've got my deal over here. So my vision is pretty large of what this could be, but it all comes back to how do I give value back to the people that I'm trying to bring into this community of mine as I do this. So it's really exciting stuff. And yeah, the more people I meet, the more of these
right.
ideas come up.
So I do think that my view looking outside, looking in, is that you only have so much time of the day, right? And almost so much brain power. And so you have to allocate how much time and effort you're going to do on this deal, right? Or are you
Yeah.
trying to get 100 unit property because it only will take twice as much time as a 10 unit, but it's 10 times as big.
Yeah.
Maybe
Yeah.
you don't do this, right? So you have to decide where to allocate your
Yeah.
you in order to do that.
Yeah. For that, first of all, I still have a full-time job. I'm a full-time engineer. I'm doing my coaching business and I'm investing in real estate. And then, so yeah, the fun to fun things is probably a little bit in the future, but probably not too far in the future. Because really, it's just raising capital. And really, I'm always raising capital, right? I'm always going to I go to networking events all the time for the primary reason to meet people, and figure out, hey, what are their needs and how can I give value to them with these tools and things that I have in my arsenal. I started a newsletter and things, trying to bring people into that, keep them engaged, teach them about real estate. And again, if I don't have a deal yet, then I'm still like talking to these people and engaging them. And I think that'll just engage them more to add this extra thing. So it's not even, and then also then I can actually learn by doing, okay, I'm actually now I'm I have a target amount I need to raise. This is an awesome deal that I love, and I'm helping people do it, and then I'll be part of the deal. And these are usually 5 to 10 year deals, but it's definitely the long game, right? But you're getting an equity stake in those deals by doing this. My goal in the near term is like next year, probably next year would be to switch to part-time at the day job so that I could spend more time exploring these ventures, building the portfolio, and then I'll qualify for the real estate professional status for sure. But right now, because I have the full-time job, that kind of hinders me a little bit there.
So for me, I'm lucky. I
Yeah,
clearly
yeah,
qualify for it.
yeah.
That's my 100% job.
Yep,
So
exactly.
it's interesting because I'm in real estate and because I'm a broker and I myself I've done 65 transactions as representing buyers and sellers in the past year. And then I also broker, so I have agents that work for me. That's clearly my stuff. My
Yeah,
investing is, is secondary, right?
yeah.
But it's also it depends because in the market in New York that we've had, it's everything's run up more than it ever should have. So nothing's cheap. Because nothing's cheap, there's not things that like you're like, oh my God, I need to have this. So
Mm.
myself and some of my investor friends are probably more on the sidelines waiting. Not that I want this to happen, because I if everything keeps going up, then we probably won't get in. But like Warren Buffett's
You're
always,
right.
you have to be a contrarian, right? You have to put
Yeah,
money in when everyone's afraid to do it. Right.
yeah,
Where you're like, I'm
exactly.
going to buy this 10 unit property in this town because while it sucks right now, 5 years,
It'll,
10 years from
it'll be
now,
better.
it's going to be good. And that's where the payout's going to be. Me listening to you, it's obviously you seem like a stand up guy, but it's like you have to be careful, right? Because people that are going to invest their money, as we know, you might, not you, but anybody, right? Things can go south, or Austin, Texas can go south, or the economy tanks, and then people aren't paying their mortgage, and so many
Hmm.
things can happen. But everyone has to do what makes sense for them from a risk
Yeah,
standpoint.
yeah,
So it's funny because you're taking loans out, right? You'll laugh at me.
yeah.
The stuff that I've done is with cash. So
Mm,
people are like, why aren't you taking a mortgage out on that? You can lever yourself.
yeah,
That's risk, right? I
yeah,
think if we saw valuations that were depressed, then it would make sense for me to then, right, to take loans out and to lever myself and buy more assets. But in a market that's going so high, it's like you don't necessarily need to do that. So I think it depends on the market that you're in, timing,
yeah.
also
Mm,
your age, right? So you're younger. So when you're younger, I think me looking back, my old self look, and I'm only 56, but myself now looking back, my wife and I were probably like, yeah, maybe we should have bought more multis. And multis are, we agree with that because multis are the ones that even looking
mhm.
back now, we're like, oh my God, we could have had this and that. And for a lot less money, you could have managed more doors and that would have been a nice, because that's the greatest thing with real estate, right? If you have a bunch of doors, you do have to manage it. You don't have to be sitting at a desk every day. A lot of it can be done through your phone and through other things. And when you
Yeah,
have to get a tenant in, get a tenant out, but for the most part, they pay you if it's working out properly, things break, you send someone in to fix it, and then you get rent checks the beginning of the month.
yeah. And for me, I'm always going to use a manager, except for these couple that are here because I'm here locally and it's just a condo and I can handle that easily. But yeah, the bigger stuff and especially as a scale, like for me, I'm always going to hire somebody else to deal with
Right.
that.
And but you're
But
putting that,
I
but
have
that's
to
in your
manage.
that's in your P&L. So when you talk about $100,
Yeah, yeah.
$200 a door,
Well, look, even if it,
you've included that.
yeah, but even if it wasn't in, even if I wasn't going to hire them, I feel very strongly everybody should be putting that in their P&L because you got to be, or at least accounting for it one way or another that you're getting paid to do the work because it is work. It's definitely work. It's a job, and if one guy's going to pay whatever percent for a property manager, and you're like, I'll just do that myself. It's hustling, but I don't know. It's not a business model. It's not a sustainable business model. I feel like it's a, a lose situation. Like
Well, it's
you
also
should
going to
account for that.
prevent it, it's going to prevent you to get from getting more doors. If you're going to property
Yeah.
manage things, then you can only
Yeah, yeah,
do
exactly.
maybe
Yeah.
50 doors or whatever, 50, 100,
Yeah.
right? So you feel that you're more valuable, right? And you can get a better bang for your buck
Yeah.
from overseeing it, for getting group money together, for putting together you feel
Mhm.
your secret sauce is using your engineering smarts and MBA and masters of science and all that. You're using that, and you feel that the best value for you to capitalize on that is to be in charge of these investor groups. That's see that's a good
Yeah.
that's a plan, right? So that's your business
Yeah.
strategy, and
Yeah.
and it makes sense. And so it's also good that going into it, if I'm starting in a new state, I gotta have a lawyer, I gotta probably have an accountant,
Yeah.
or and
And to your point too, like about living where you invest, I grew up in Wisconsin, so I that's why I picked that area too, because I have family friends, I have people there that support me, but and I know the area better. But I want to get into other markets too. I'm planning to move to North Carolina and because I really want to get into that market and I want to live there first. So my plan is my next kind of thing is I'm gonna move there. I'm gonna house hack there because I as a veteran, like you have I feel like as a veteran, I have to be house hacking because I can buy a house for 0% down. Why would I not do that? I'm
right.
just like, keep adding easy. It's just easy. Just keep adding to the portfolio and no money down. But then once I have that, then I'm gonna be looking around, really getting to know that area because I'm excited to be able to just, hey, here's a property. Let me go drive by it instead of, okay, here's a property. Let me call my property manager. Let's run through the numbers, see if this is even worth looking at, and then they're gonna see if it's worth their time to go drive by it or have to find somebody to do that on their time. And it's a lot more coordination, of course, doing it out of state. But for a number of reasons, I probably won't get into necessarily in this call. I'm just California. I love California. Like the weather is amazing. There's so much to do out here. It's a fun place to live, but I'm not really interested in investing here. That's why I'm looking at other states. And I think for me, like from what I've researched, North Carolina seems like a really solid option. It's weather is still not, it's still pretty nice. You don't get, especially inland, you don't get hit by the hurricanes hard like Florida, so you don't have to deal with as much of the FEMA nonsense that they have to deal with down there. It's still a booming market in terms of the real estate, but also population growth and job growth and things of that nature. So, anyways,
No,
I'm excited about it. Yeah.
New York and California are probably two of the highest tax states, but
Yeah.
so
Yeah.
everyone like, you know
Hmm.
what? Everyone also likes to complain and say what they're going to do, and then they don't do what they say they're going to do for the most part. But like you said, you talked about it. While things cost more in New York, the rents are higher, right?
Yeah.
So
Yeah.
you can get a higher rent here. So technically, but ultimately, it is a P&L business, right?
Yeah.
You
It's
can't be
P&L
tied in
and
because you want something. Is the mathing,
yeah, exactly. And obviously, well, in multifamily, we look at cap rates, and California is just insanely low cap rates. And it's just, I can't fathom it. I get it. Like you're buying for the growth, and the growth tends to seemingly keep on just happening no matter
yeah.
what.
But at some
So,
that's
I,
yeah, it
so
is
to
until it's not,
me,
right?
yeah, yeah. So to me, I could do that, but I feel like it's just speculation. And I don't know. I'm sure people look in way into the weeds on this and they project all these. They look at all the economic models and try to figure out what's going to happen. Nobody really knows any of that stuff though.
And then 2008
And
happens, and then
yeah,
2008 happens
yeah,
again, and everyone's portfolios
yeah,
go down, and then their margin
yeah,
calls and people owe money. So I think you
yeah.
have to
So
take a
like,
long,
yeah.
you do have to take a
There,
long-term view.
yeah, and there's definitely, I get what you're saying about leverage, but you can manage if you're worried about leverage, in my opinion, like you can still take out a loan. Just don't take out an 80% loan or a 75% loan. Take out a 60% loan. I don't know. Figure out what works for you. Thinking about it, right? If you take out a 60% loan and your value has to drop 40% to be underwater. That's
No, but it
chance of
costs
that
money.
is
But
crazy.
one view is that it does cost money to borrow money, and so,
Okay, yes, but if you're in a market where the cap rate is higher than the interest rate, then you're actually accelerating your gains. You're
so
always going to accelerate your appreciation by borrowing money, but you're also going to accelerate the gains on even on the cash flow if you're
that's if things go up, right? Prices go up. They don't always go up. What happens when, you know, there's too much supply, when they're building a lot of supply, and then the cap rates come down because yours is not the newest anymore, right? But ultimately, I think it's based off of, there's no point of pulling money out necessarily if there's nothing that you're going to do with the money. So if I own something that's, we're all in for 735, it's now worth $1 million, it's all cash. I could take a lot out. What am I going to do with that money? So unless I find something that I'm going to do with the money, I don't necessarily need to do it. But yes, the good news is, waiting for valuations to be different or better, right? For me as a buyer, I have that as a possibility, as opposed to being fully invested now in things that are expensive. But it's also what, in the end of the day, some people could be levered all over the place and still sleep like a baby at night. Some people can't. So it's really about how risk averse and risk tolerant
yeah,
you are. And I think that's the whole point, is that you got to be the investor that makes the most sense for you. And it's also different, right? Is if investing is 100% of your business, or is it like a side business that's nice, right?
yeah.
But it's good, and it's
The
good for
the
you
other
to know. Mhm.
I was just say the other thing to keep in mind with this is if you have a certain amount of cash and you only buy one property with cash, you're in one way you're actually increasing your risk is
Right.
because now you only have one property. And if things go south on that one property, you're screwed because that's all your cash went into that one. Whereas if you spread it out across multiple properties, you have more doors, you have more roofs, you have more, it really levels out your gains. Like it smooths out your gains. So she could hit the fan on this property, but now you have all these other properties paying you money to handle that. And then shit can happen on this property. But like chances are they're not all gonna have problems all at the same time, especially if you
Right.
have 2,000 doors.
That
But
I think I
yeah.
true, but your analogy is also if that's your only asset. If you're only doing real estate, right? So being an old
Hmm.
man, I have a lot of money in the stock market, right? So
Mm.
real estate
Now
is
we're
just
talking about
one
risk.
component, right? Real estate is just one because I've put the maximum I can every single year in, and then when you start getting older, you're like, holy shit, that's a lot of money, right? So ultimately, for some, the real estate portfolio is just as small as a sliver of what things are. So you're right, though.
Mm.
If my only thing was real estate, then I would want to have maybe single family. I'd want to be in different markets at different price points, right? Because you're right. I would want to hedge. I would want to hedge and not just have everything, all the bread in one basket, right? So I think that's the other thing, is you need to, understand where people are, what they're in their life, where they are in their life stage. Also, when do they need to pull the money out? But what else do they have, right? But real estate has this amazing, people that don't do it need to do it at some point, because it takes risk off from just the stock market and chips and Amazon and Facebook, and right, and it's more in your control.
Yeah.
It might
Oh,
it might not
absolutely.
be as
Yeah.
sexy. It might not be as sexy 10%
Yeah.
returns, but that would be the goal. So but it's good to have your hedging really by doing it. But you're right. If you take some money off and then you put it into another type of investment, I think
Mhm.
those are, again, in New York, if as you see or those opportunities come up, then I think it's important. But I like what you said before, and then we could talk for a long time, and but we do have to
Yeah,
go at
yeah,
some point. But is to when you see a property and you do the P&L, you come up with what your bid's going to be. Maybe
yeah,
there's a little bit of a give and take, but
yeah.
you can't, there's always going to be another project. So don't fall in love with the project because you like the
Yes.
town, you like whatever, because ultimately it is numbers, right? And the numbers, the math needs to math. And in our business, people get slightly too emotionally attached to properties,
Yes.
and that's funneled some of the inflation of properties,
Mm,
right? Because maybe it's a
yeah,
little different in what you're doing because you're just doing investments, right? It's
yeah,
worse when someone's going to live there. But you're like, oh my God, I have to have this house. It has this backyard. It has this. It's next to the
hmm,
school, whatever. And so they drive up the
yeah,
price more than probably what they should because of emotions. And
yeah,
as you're on your way to 2,000 doors, my advice is to you run the numbers. This is what it makes sense. And my best investors do that. Not me, my best
yeah,
investors, where I see this is the offer that they put up. Maybe there's a little bit of wiggle room, but generally they're giving that's
yeah,
the offer. And if you like it, great, let's move ahead. If not, I'll still be there if other things come through. And if other people want to pay more than what I'm willing to pay, then you should take it because
yeah,
that doesn't work for me. You
definitely.
never know. Different people, right? Different
Yeah,
people have different cost structures,
yeah.
or they came into
It's
money and they
interesting.
don't care or they don't know. There's a
Yep,
lot of different
yep.
things out there.
Yeah, there's one I offered. They were asking 10 million. I offered like 7.5 because that's where my numbers came in. And I felt that was really stretching it too. Like I wasn't even super comfortable with that number. But I'm like, they're asking 10. That's as high as I could go. I feel like this is still going to be a winner. I was like, there was no negotiating though. There's no way I would could even come up from that number. And then somebody supposedly submitted something in the nines, is what they told me. But now I think it's back up on market at 10 again. So I don't know.
Exact. And
It's kind
again,
of
you
a
have to
game.
let you know what sellers are allowed to ask for whatever they want. That just
Right.
because you ask for
Yes.
that doesn't mean that's what it's worth, right?
Yeah. Yeah,
So,
exactly.
I like you're staying with your number. That's the number.
Yeah.
It doesn't work otherwise. And that, you know what? At some point, you can still say, I'm still at 7.5. Things could happen and they could change, or you're down to 7. So,
Yeah. They come back and you know what? I don't feel comfortable with that actually. Let me
right.
do seven. Yeah.
Exactly. Because
Right.
clearly nobody wanted it. If they come to you, nobody
Yeah.
wanted it
Yeah.
above that. Well,
Exactly.
Chris, thank you very much for being on the show.
Yeah.
It's
Thank
a
you.
part of the business that people want to get involved in. I hear a lot. They're afraid and they don't know enough about it. I love with being a military person, Marine or a veteran certainly gives you the credibility of that your work with Habitat for Humanity, your coaching, your amazing degrees at two amazing California universities really is setting it up that you understand business and you're learning and you keep educating yourself. So that's only going to be good for your deals and deals that people come in with you. And so you're like a testament to what can be done. And you're working to do it as quickly but smartly as possible. And I wish
Yep.
you all the success in doing that.
Awesome.
So,
Thank you. Really
okay,
appreciate you
thank
having me
you.
on.
Sure, my pleasure. It was great talking and learning. It's everyday conversations are just about how do you better yourself and all that. And I appreciate the time. And everyone, thank you for joining me for another episode of the Adventures of a Real Estate Broker. Chris, thank you very much. And until the next time, thank you for listening. If today's stories opened your eyes, wait till you see what's next. Hit the video on screen to join the next adventure with Daniel Berger.